Today we will continue our masterclass regarding the Forecaster terminal. This is the third lessons, and today we will have a deep dive into the commodities. So let me share my screen and let's start with the lesson of today. Tanti saluti dalla Germania is saying Sven. Thank you very much, Sven. If you are not Italian, tanti saluti dalla Germania, it means greetings from Germany. Thank you very much. Hi, everybody. So, first of all, as you probably know, as always, let me remind you that the Forecaster terminal is built like Google. So, as you can see in Google, you have a search bar where you can find direct what you are looking for, and you can go to the tools you have here in your workspace. Exactly like Forecaster, you can search a financial instrument directly, or you can go here where you have all your tools and you can get ideas from our tools. As I told you today, we focus on commodities, okay? And let's start with the most famous commodity in the world, which is the gold future, okay? As always, if you have any question, feel free to write in the chat. Thank you, Vasim. Thank you, Todd. Thank you, Ali, Anil. You are so many today, so I'm really happy to see you in the chat. So, as always, the forecaster is built to have different kind of analysis on a single instrument. So, for example, now we are on gold, okay, because we search directly for gold here, and gold is one of the suggestions that we have from the software when we dial, when we start to search something in the search bar, okay. So, as for every other's instrument, we have an overview page, very easy overview page where we can see the performance for this instrument all across the time frame. So we have 10 years, 20 years, 5 years, and blah, blah, blah. Okay. And here we have the single year performance. Okay. This is a very nice page. It's very interesting because we can get a big picture idea, okay, of what happened in the past. Okay. The second layer is the seasonality. And in this case, talking about the commodity is something really, really interesting because commodity, as you can imagine, tend to have a very strong seasonality. Okay. So, for example, here we are on the gold, and starting analyzing the seasonality, we can definitely see, for example, this is the today date, okay? And as always, we can add, for example, the current price. We can add different kind of seasonality, for example, last year, 3 year, 5 year, and we can go back until, for the gold, 30 years, okay? What does it mean? Very simple. For example, let's concentrate, for example, on the 10-year seasonality. So it will be much easier to understand if you approach the seasonality for the first time, okay? Here we are. What you're looking at in pink, it's the current year. It's how the gold is moving right now. What you are watching here in, let's say, red, it's the 10-year seasonality. It means that we take prices for gold starting from the 1st of January until the end of December for the years 2024, 2025, 2023, 22, 21, 20, 19, 18, 17, 16, and 15, 10 years, and we do the average, okay? Doing the average, we can definitely understand and see on the chart if in a specific period of the year we have a specific trend, okay? And of course, this is something we already used for the indexes in the first lesson of the master. This is something we used for stocks in the second lesson of the masterclass, and today we will use it for gold, for commodities, and of course you can use for all the instruments we will see during this masterclass, okay? This is something very interesting because, of course, if in a specific period of the year we have a specific pattern, of course, it means in general, okay, in this period we are watching, we can experience that kind of trend, okay? I always do the example with the temperature. If we write on Google New York City, temperature, okay, and we go here, as you, here we are. This is a chart where we can see the average temperature for New York City, okay? As you can see, this is a very nice example of seasonality. We can actually go also to our website where we have a very nice description of seasonality. Here we are, and we have the same chart, okay? So we can definitely switch to our website and not to this random website regarding New York City I found on the internet, okay? And as you can see, talking about temperature, which is a very nice example of seasonality, okay, we can definitely say that during January we have a temperature, a medium temperature in New York City, which is below zero. We can definitely say that in July we have a medium, an average temperature of more than 24 degrees, okay? And of course, what does it mean? It means that this is an average temperature, okay? That goes from below zero to more than 24 during summer, okay? It means that we can expect this temperature, but of course, during the year, we will also have drops, okay, of the temperature. But in general, if we have a pattern, temperature will go back to the average, okay? And this is something that or happen also on the stock market, okay? And in general, also with commodities, okay? And this is something very interesting because thanks to the forecaster terminal, we can see on the chart if we have a pattern, but we can also highlight on the chart a specific period, and going a little bit down in the page, we can see which are the statistics. So for example, in this case, we highlighted from, let's say, today until the very beginning of August. And here we can find all the statistics. In this case, if in the past 10 years we have been long, 50% of time we had a profit with an average return of 9.8%, okay? And here you have all the different years in the same period, as you can see, with the specific statistic for the single year, okay? And this is very interesting because we can definitely understand if a specific period of time it's more bullish or bearish. In this case, for example, we have only 50% of odd to have a long period, okay? If we switch to short, we can see something very interesting. Of course, if we made in the past a short trade exactly in this period, of course, the winning percent remain 50 because 50 is 50. So even if you are long or short, you have the same winning average. But in this case, something really interesting happened because look, the average return for a short trade in the past 10 years in this specific period, look, this is the average return, 4.2. So we can understand that compared to the long, where we have a 9.8, this specific period we are approaching, okay, is more bullish than bearish, okay? And this is something really interesting. Here in the seasonality, we also have the correlation, okay? This is a very interesting data because thanks to the Pearson formula, okay, we calculate how the actual price, how the current year is moving compared to the seasonality, okay? As always, everything is explained here. Every time you find an info box, if you click, you find a complete explanation, okay? Correlation show how two things move together. If they are positively correlated, when one goes up, the other usually goes up too. We use the Pearson formula to measure this relationship between the current price and different seasonal patterns. Okay? It tells us how closely changes in one thing match changes in another, and it calculates over 60 business days. Okay? Pearson formula, of course, if you would like to search, you can find everything online. If you would like to go deeper inside the formula, there is also a Wikipedia page, so you can have all the information you want. Very simple. We know, for example, with an 87% of correlation between the current year and the 10-year seasonality, that we have an high correlation. It means they are moving very similar because out of 100 days, 87 are moving exactly like in the past. Okay? Let me see if we have Anil, this formula is taking me back to the university days. Nice. Yes, exactly. What we do with the forecaster is just taking what you can learn at the economic university and we plot it here in our software with a very nice user interface. That's it. We don't want to how can I say? We don't want to invent nothing. This is not a black box. We don't want to tell you what to buy and what to sell. We would like to give you the data, the datas you can use in order to take your decisions, okay? Regarding trading and investing. Of course, what is very nice also regarding the seasonality, at the moment, as I told you, we are watching the 10-year seasonality, but of course you can do these these analysis also going back, for example, to 20 years. Look, for example, 20 years is very interesting because we have a very high correlation. Okay, we have a 91% correlation. Okay, and it's very interesting to see, for example, on 20 years, the average winning goes up to 60%, which is very, very nice. Okay. Anyway, let's go back to 10 years just in order to keep the analysis very simple. But as I told you, You have also the daily average, very interesting because, for example, in the past 10 years, you can see that today, which is the 13th of May, 71% of this specific day were long. And of course, you can find really interesting statistic because look, for example, the day 20 of this month was 86 long and the day 21 was 100% short. Okay. So lot of people that are using the forecaster, for example, for intraday trading, they use these statistics in a very nice way. For example, they they wait until the 20 of the month, okay, on the gold, and they wait until the very end moment of the day and they place a short, okay, because the odds for a short day for the day after, which is the 21, are very high, okay. And of course, i leave to your imagination all the ways you can use this data, and it's very, very, very nice, okay. Of course, you can also find the weekly average with the single days. Okay, so for example, here we highlighted a specific period, and here you can find the odds for every single day: Monday, Tuesday, Wednesday, and Friday. Okay, and also the monthly average. So for example, as you can see, September, for example, in the last 10 years was a really bad month for gold. And as I told you, you can also add other seasonality. Okay, so if you would like to have the same statistics for the last 20 years, look, here we are. For example, the 21 of May is a very bad day for gold. Look, because both in 10 and 15 years, we had 100% of short, which is an amazing statistic. Okay. And also here, as you can see, we have a consistency. Look, June is 70% in the last 10 years, 67 and 65. I mean, it's very consistent, this data. Look, September, very bad month, 90% short in the last 10 years, 80% short in the last 15, 65% in the last 20. If we go here, look, the 21 is 100% short also in the last 15. Very nice data. Harry is asking me, 25 years of seasonality show 92% of correlation. Should we use this? Of course. For example, what I always do using seasonality for commodities, but also for all the other instruments, I, in general, plot all the seasonalities, okay, and I watch which is the seasonality with the highest correlation. So in this case, for example, we have 92% correlation with the 25 years, okay, nice. If I would like to use it, it's good to use it because I know that compared to the actual price, to the current year, okay, it's the one which has the highest correlation. So I know that if this correlation continue to stay so high, okay, if will tend to stay high, it means that the prices will probably move as what they did in the last 25 years. Okay, so for example, watching at this chart, I can see a very high correlation. So I can definitely highlight, for example, this period where on the chart, but we can also do here, look, on this chart, I can see there is a bullish trend, okay? And I can go and see the statistics. In this case, Okay, we can also do a little bit more so we have more reliable statistics. Okay, starting from today until the end of September, look, in the last 25 years, we had 64% of winning. It means out of 25 years, we had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, and 16 year of positive returns with an average of 8.7. Look, if you would like to understand if in a specific period you have a high consistency results, you have to try also the short. In this case, both the winning percent and the average return are higher compared to the short, because here we have only 36 with a 6.8% return. Okay, it means in this specific period a bullish trend is more probable. Okay, here we also have the correlation, so we also know that out of 100 days, 92 days are moving exactly like they did in the last 25 years on average. So this is exactly what we can expect from gold in the next month. So as I told you, the forecaster term, you can use the forecaster terminal in many ways, but actually this is a very nice method to use it, okay? Because we know that historically speaking, gold moved I mean, we know, for example, using I don't like to use very long seasonalities. In general, I use just in order to understand which is the seasonality for a specific instrument. I use something between 10 and 20, okay? Just for understanding how this specific instrument did in the past, okay? For example, June, it was historically speaking a bad month for gold. September, historically speaking, was a bad month for gold. But we added the correlation, okay, because what happened in the past is not a promise for the future, okay? So we added the correlation in order to understand if today we can rely on seasonality. And in this case, of course, we can also use the 25-year seasonality because has a very high correlation with the current year. But as you can see, the analysis for the next month is very consistency, because we have a high correlation on every seasonality, okay? And of course, we can expect a result between 8.8% and 6.9%, okay? So on average, let me say, we can expect for the next month a upward movement for the gold of something near 8%, okay? And in this case, we combine seasonality and correlation, because of course seasonality tell us what a specific commodity did in the past, but thanks to the correlation we can understand if we can expect it also in the future, okay? And this is something amazing and important. Of course, we have also the overbought and oversold layer, okay? And we already talked about this indicator in the previous lessons of the masterclass. So I will go very fast with this lesson. Okay, here we have this indicator, which is inspired by the CNN fear and greed index. The difference between the fear and greed index and this indicator is very simple. We calculate this indicator on every financial instrument, including commodity. The CNN fear and greed index is very nice. As I told you, we have been inspired by this one, okay? But you can use it only for the S&P 500 and stock market in general. We created this indicator thanks to statistics, thanks to, here you have all the explanation, okay? But is a mix of the advanced DPO, the Wyckoff, and the speed, which are the other indicator you can find on this page, okay? As you can see, thanks to this indicator, we can find overbought and oversold moment on the chart. And of course, when we are in oversold, which we also call panic selling, we are in a buy area. When we are on oversold, overbought, which we also call FOMO, fear of missing out, we are close to a potential top, okay? For example, in this case, how can we interpret this indicator? Very simple. We are exactly in the middle, okay? So it's a signal that we can expect what the seasonality is telling to us, because as you can see, the indicator is rebounding, is jumping on the zero line, which is something that happened also in the past, okay? So in this case, we know that the seasonality is bullish, okay? So this is something like a bullish signal from the indicator, okay? Because we are not on the extreme part of the indicator. We are not in overbought, we are not in FOMO, we are not in oversold, we are not in panic selling, we are just neutral. So we actually don't have any buy or sell indication. We have, let's say, an old indication, and so we can rely on seasonality. Of course, the last layer for the commodities is the COT report. If you don't know what COT report is, very simple. We can go here to the CFTC Commission website, the Commodity Future and Trading Commission. The COT report is a very interesting report that this commission publish every week to help the public understand the market dynamics, okay? So it's something you have available only for futures, listed future at the CME, okay, which is a stock exchange, and you can find this report. Oops, sorry, I closed the page. You can find this report here. This is for example, as you can see, palladium. We have also the copper, we have cobalt, we have lithium, aluminum, let me see, steel, and all the commodities. Look here, we have the gold, okay? And this report is telling us if, for example, how many long and short position, for example, managed money has in this specific moment, okay? Of course, this report is terrible because it's very difficult to understand something inside all these numbers. What we do on Forecaster is very simple. We take all the historical data and we plot on the chart together with the gold in this case, but we have this chart for every commodity, all the position for every single category we have on the COT report. So we have, for example, the managed money. We are talking about the hedge funds. We have the producer, merchant, and processor, which are, of course, the producer of gold, okay? And by default, you can find the net position, which is the long position minus the short position, okay? In order to analyze the chart, you can definitely use the net position, okay? What we can see, it's something really interesting because we know, for example, that right now, during the last bullish movement of the gold, the managed money, we are talking about the hedge fund, closed a lot of long positions, okay? And you can understand what they are doing with their position regarding a specific commodity. And this is amazing, guys, because we can definitely understand many things regarding the potential future, the potential movement in the future for a specific commodity, okay? For example, what we are looking for are, as always, divergency. When we find the divergency between the net position and the prices of a specific commodity, we can definitely say we have an opportunity, okay? If, for example, we find a divergency and both the oversold and overbought and oversold is telling us, for example, to go long. The seasonality is telling us to go long, and the institutional investor are betting long. I mean, our odds are very strong for a long trade. On the gold, we have a divergency because, as you are saying, as you wrote in the chat, if the managed money was selling their position in gold and the price was going up, isn't this a bearish divergency? Did I misunderstand something? No, exactly, correct. So, for example, talking about gold right now, we have a bullish prediction thanks to seasonality. We have an old indication from the overbought and oversold page. Actually, we don't have a buy or sell signal, so we don't have an indication. And thanks to the quote, at the moment, we have a divergency. Yes, of course, you are right. Will I bet short on the gold because only of the quote? No. And this is why I created the Forecaster terminal, because I would like to bet, I would like to invest, I would like to trade only when my odds are on my side. And in this case, only the COT report is telling me that I have a divergence. But this is not a selling signal. This is just a divergence. It will turn in a selling signal only if prices will be in an overbought situation and I expect a downward movement from the seasonality, okay? Is it clear for you? Perfect. Thank you very much, Scott. Perfect. Perfect. So, as I told you, the COT report is very interesting because we have this voice: producer, merchant, and processor. Okay, this is a very interesting voice regarding the commodities, because these guys are the ones are really producing the commodity we are talking about. Okay, these are the guys that take out the gold from the ground. Okay, so they know everything about the gold. They know exactly how much it costs for to them to extract this commodity from the ground. They exactly know how many orders they have. They exactly know everything about the commodity. Okay, and I don't know why nobody across the globe are using this data, which is very, very interesting, because now I will show you something amazing regarding this data. Okay, because look, I can show you to let you understand something on the natural gas. Look, let's go here. We can go to, let me see, natural gas. Look, first of all, producers use the futures in order to protect themselves from price volatility. Okay, follow me, because this is very interesting. Futures, they was born to let this exactly category of people to sell in advance their product. Okay, so for example, to keep it very simple, okay, this is the factory that produce the natural gas. They take the natural gas from the ground and they put it in a big tanker. Okay, sorry, I'm not an artist, but try to imagine this is a tank with inside the natural gas. Okay, starting from this moment, which is the day one, let's say, until the day they will get the money from this natural gas, that could be, let's say, 60 days later, 60 days later, 60 days. Okay, I'm sorry for my paintings, they are terrible, I know, but anyway, you got the point. One day, okay, after 60 days they get the money. Okay, producer has a very big problem during these 60 days, because the price of natural gas will move during these 60 days. So for example, if they sell today the natural gas to someone that, if they extract the natural gas today, okay, and they will sell it in 60 days, maybe can happen that the prices fall down, okay, in these 60 days. Okay, this is why the future market exists, because it allows to producers to short future contract. And very simple, if they short, it's like they are freezing, okay, their deal. Okay, because if they are short and during these 60 days the price will fall, okay, they will gain a lot of money thanks to their short position on the future market. Okay, of course, they don't care if the price will go up or down because they are covered by the future, okay? If the price follow, they will make money thanks to the short position. If prices will go up, they will make more money thanks to their natural gas, the real one they are selling, but of course, they will lose money on the short position. So actually, what they are doing, what producers are doing, thanks to the futures, is just freezing the position. They doesn't care. They don't want to. They sell gas. They sell natural gas. They sell a commodity. They don't want to speculate. Okay? Is it clear, guys? This is very important. Thank you, Sven. Sven wrote, I like your art a lot. I don't know why, but if you like it, I'm happy. Okay. They equalize the price, is writing Anil. Okay, perfect. They lock in their sales price, Scott wrote in the chat. Exactly. Perfect. So you understood. But what happened? Everybody would like to make money. And this specific category of people knows everything about the price of the commodity they are selling. Okay. So sometimes something really interesting happen with the net position of these guys. Look, sometimes they see the opportunity to put themselves in a long trade. And guys, this is something that is happening right now. This is why I'm showing you the natural gas. Because look what happened. Sometimes they said, hey guys, why don't we use the future market in order to make a bet? Because we know we have many orders. We know the price is very low because we know everything about this commodity. Why don't we place a bet? And sometimes they do. And in general, when their net position is long, we are very, very close to a very important law. And this is something you have to watch for every commodity, guys, because these are the smart money in this market because they produce the commodity. They knows everything. They see the orders coming. Okay? And this is exactly what is happening right now with the natural gas. Of course, Anil wrote in the chat, they have inside information from other competitors too. Of course, guys, we are talking about commodities. In this case, countries buy natural gas. Okay, we have all the information regarding this. And of course, it's something that happen not so often, but it happened. And of course, we have many commodity to watch. Okay, but this is something amazing. Okay, because for example, right now you can see their net position are long, very, very nice. Okay. Something similar happened with the sugar, Anil is saying. Of course. If you go here, up in the page, and you go to COT report, and you go, for example, here on sugar, okay, look, this is a pattern that occur all the time. And of course, you can use it also for the opposite part, because when they are shorting a lot, it means they are really scared about the price, okay? And of course, when prices are very high, for a specific commodities, they tend to be very short, okay? So, for example, right now, the same situation we have on the natural gas, we have on the sugar. I mean, we can definitely see producers are not betting anymore for the short side, so they are not scared about losing because the price of sugar go down. Okay, and this is the best bullish signal you can see in the commodity market. Of course, we can also find good signals and good divergency with managed money and non-commercial, which are actually the same, okay? But this is game changing, guys. And this is something that I don't know why nobody are talking about all across the globe. I watch all the financial analyst video all across the globe and nobody's talking about this. I don't know why actually. Sugar is asking Sven. If you look at 1 year chart of producers, is that a divergency? Look, in the case, in this case, yes. Look, here we have a divergency because look, here we have volumes, the net volume that are going up. And here we have a chart which is going down and made a lower low. You can also switch to line if you prefer. Maybe I really love this kind of chart with bars. I love it. But some people in my organization said, look, it's better to have the line chart. And of course, we plot it also this one. But I prefer this one. Yes, this is a divergency. And this is a very strong divergency because it's made by producer, merchant, and processors. Okay? Let's go to have a look to some very cool examples. Okay? On the rice, which is a market, to be complete honest with you, I don't trade, okay? But it exists. Look, very interesting situation because we have prices which are very low with the institutional which are very long. Sorry, the producer which are very long. Look, and this is something that happened also in the past. Very, very nice and very interesting. Okay? Really nice. Do you like this producer and merchant trick? I love it. I mean, you can definitely understand something really deeply thanks to the producer because of course they are there to make money. If they see the opportunity to make an extra profit thanks to future market, I mean, look, very simple. What you see right now are the net position. Look, by default, on every chart you see net position. When you have a chart like here, which is below the line, it means that the net position is short. Okay? And as you can see here, prices of sugar were very high. And of course, they was short because thanks to the short positions, they freeze their deals, okay? As we said before. When the net position switch on the upper side, it means the net position are long. The net position are the long position. As you can see here, we are only on the upper part, minus the short position. As you can see, for example, in this case, since the beginning of 2024, this category, the producer, are closing down their short position. Here we are on the short position, okay? They are just closing down their short position because they think they can make an extra gain, they can make extra money thanks to the rise price, okay? Look, and they are also closing a little bit the long position, look, okay? Just a little bit, but they are definitely long. And look, the result is a net position which is very bullish. How long do you take a future contract for when you do these trades? I tried trading future 20 years ago. I did not look the whole overnight position. Look, for example, as I told you, I don't do the rice. I do the gold, I do the natural gas, but I use, for example, different instrument. For example, I go for the CFDs. I go with the mini futures and this kind of thing. You can also use, for example, the ETF. I mean, you can use the instrument you want. What you have to learn to do is the analysis in order to understand if the price will go up or down. That's it. Okay. Some other example. Here we have an example on the gasoline. Look, for example, here we can definitely see a very nice recurring pattern. Look, starting from July until the very beginning of December, on the seasonality, here we are back on seasonality, we can see a specific pattern. In this case, as you can see, both on 3, 5, 10, 15, 20, 25, and 30-year seasonality, we can see the same pattern. It means that, historically speaking, in this specific period, we have a very nice trend, okay? Look how powerful in this case is the seasonality. This is an instrument that really tend to repeat himself very perfectly. Yes, of course, Earl is saying it's interesting inside, but often it takes a long time to see a price reaction for the future positions. How could a person better time the market with this future data? Very simple, guys. Very, very simple. You can use, you can do an analysis where you go also with the COT report, but then you can time the market thanks to seasonality and overbought, oversold. Also on sugar, it's very nice, for example, because look, we saw on sugar that the producer and merchant are turning long, which is a bullish signal. And look, for example, here we are in a moment where the seasonality is telling us, with a very high correlation with the current year, that prices has a very bullish period in front of us. Because look, both in 7, 10, 15, and 30 year, we have a winning percent, which is on our side, with an average return of 21, 23, 28, 29. Okay, these are very good statistics, for example. Okay, and in this case, this is a way to time the market thanks to seasonality. Okay, we know we are in a very bullish window. And also we can go to the overbought and oversold page, where we can see, for example, that the market mood meter just turned bullish. Okay, it just went to the lower part of the indicator, the band where we can experience very important lows, and now it's turning because, as you can see here we are in a neutral position, but we can definitely say we are on a very important low. Okay, if you see an historical, a much longer period, look, we are definitely on a very important low. And in the case of sugar right now, all the different analyses you can do with the forecaster, seasonality, overbought and oversold, COT report, tell us that the sugar has to go up. So in this case, we have very strong odds in terms of, we have a very strong odds related to a bullish period. Pierre, why is the correlation so low on RBOB seasonality? Doesn't match with the charts? Easy, because the actual price is not moving as the historical prices. That's it. Very simple. Very simple. Look, at the moment, okay, look, we are right now in May. If this is a very nice example, thank you very much, because I would like to show you something. Because, for example, here we can find all the correlations are very low, especially the 15 years, which is the lowest correlation with the 19%. Okay, so let's isolate only the 15 year, because when you find such a very low seasonality, a very low correlation, it means something really interesting. It means that probably the prices will do the opposite, okay? Because if we have a very low correlation, like in this case, what does it mean, 19%? It means that out of 100 days, only 19 are doing like the historical seasonality we have on the chart. It means they are doing the opposite. If we detrend the chart, we can definitely see that at the moment gasoline, okay, is moving exactly opposite to what it happened in the past. Look, here we have a top, here we have a low. Here we have a top, here we have a low, okay? So in this case, here we have a top, here we have a low. In this case, we can really expect for the gasoline price that will move the opposite for compared to the seasonality. So for example, in this case, historically speaking, we have a potential short period, because look, in the last 15 years on average, in the last 15 years, 73% have been short years in this specific period with an average return of 13%. If we had a long, we had a profit only in the 26% of cases with an average return which is lower than the short. Okay, so this time period, this time window, historically speaking, was short, but nowadays, right now, prices are moving exactly the opposite. So we can expect the opposite. Okay, let's have a look to the producers. Also, in this case, the producers has never been so bullish like they are right now. Okay, look, they just been a little bit more bullish here in 2024 when the gasoline did the most important low. Okay, so we can expect higher prices for the gasoline because the producers are betting long, and seasonality is telling us that despite the bearish time window we have in front of us, the actual prices are moving complete to the opposite side. Something very important related to the commodities. Of course, you can find many, okay, because we have agriculture, we have metals, we have the petroleum, the natural gas. Something really interesting, if you like to trade, you can go to the quantum screener where you can find and you can isolate only the commodities. In this case, for example, if you would like to choose a 3-month trade, but you can choose 1, 3, 6, okay? Here you can find which are the best correlation for the commodities. So for example, in this case, look, on the lean hog futures, okay, we know that the actual price has an 89 correlation with the 20-year seasonality. If you click here, you can click the page and the forecaster opens a page where you can find the current year with the 20-year seasonality. And here you can find something interesting because look, we know that for this specific commodity, for the next 3 months, for example, look, we have a 95% odds with an average return of 15%. And the quantum screener, which is inspired by Jim Simon's strategy, give you in 0 seconds all the best opportunity on the market. Okay, very, very nice. You can also find the worst correlations that we know, because I told you that we can use for the opposite side. Okay, but we can also find here, as you can see, we can find on sugar, we can find on gold, which is what we found before. If you click to best to worst, you can find the balance between the best correlation and also the win rate. Thank you, thank you, thank you very much. I just ask you a favor before to say goodbye. If you go to Google and you write Forecaster.biz, you can find the review page. If you please can write us a review, I really thank you very much, because we really need it in order to go abroad. At the moment, we are with the forecaster very strong in Italy, as you can understand from my accent, but we are really trying to go abroad. And for example, at the moment, a lot of people are using the software also from the States, from the Saudi Arabia, and also in Africa and in Australia. But of course, we are still very little abroad. So please leave us a review. Of course, 5 stars will be very appreciated. And if you have not 1 minute, but 2 minutes, if you go to Trustpilot, here we are. If you leave a review also here, you are very welcome, because it's very important for us. I leave you the link also for this one. If you help me with these reviews, I will be very, very happy, and I can continue to to share my knowledge, let's say, with you for free, of course. And that's it. We are really trying to do something great. We really love our software, I know you love our software. If you can please write us a review, I will be more than happy. And that's it, guys. See you next week with another lesson for the masterclass, and we will go deeply on other or something else. You can go also here, look on the Forecaster Terminal web page, and you can go here in tutorials, and you can find the previous lessons. Okay, you can find both the article and the video.